There's no risk-free path to interest rates. That's the warning from Fed's Powell, which caused the US dollar to bounce back today. And as you can see, the New Zealand dollar is the weakest, followed by the euro, the pound, and so on. We have the dollar yen weekly chart in front of us here, which has found further support on the back of the big surge in new home sales data that was released moments ago, and keeping the upward pressure on the dollar yen intact for now. But with the Bank of Japan expected to hike interest rates while the Fed is cutting, this could put upward pressure in Japanese yields relative to the US, which could undermine the dollar yen, especially as it's now approaching this major area of resistance, as you can see on this weekly chart. This area between 148.65 to 150 is a massive area of potential resistance to keep an eye on the weekly chart of the dollar yen, because this is where the dollar yen had previously rallied away from back in the end of last year before rates topped out in January. The dollar yen then fell quite sharply in the space of a few months before bottoming in April along with all the other risk assets. It has since tried to break back above this zone of resistance, but so far it has failed to do so. Therefore, this makes it very interesting to see what the dollar yen does here, because if it manages to poke its head above this bearish trend line, that could potentially signal that rates may be able to push a little bit higher and possibly take out the July high of 115.91. On the other hand, if we see a quick break and a move back below the trend, that could be a sign of trouble for the bulls. So watch out for that potential bearish signal. Another bearish or potentially bearish scenario would be if we go below the high from last week, when we saw the formation of a hammer candle on the weekly time frame. So what I mean by that is, even if we don't get a false break above the trend and instead the dollar yen holds below this area of resistance and we go below the high of last week's range, that could be a bearish sign, given that this should have led to some follow up to the upside. But the potential lack of upside follow through would be the first signal that I'll be watching for in terms of bearish signs on the dollar yen. So in the event the dollar yen goes negative on the week now, I think that would be a significantly bearish technical development, in which case we could well see the dollar yen fall to take out liquidity that would be resting below the low of that hammer candle. And then if and when we get there, I think that could potentially expose the downside risks to the 200-day moving average, which comes in at around 142 area. Below that, we have the psychologically important 140 handle next. But we'll cross those bridges if and when we get there. For now, it's all about this bearish trend line and this shaded resistance area. Keep an eye on crude oil prices, because the WTI chart here is approaching potential resistance at around that 65 key psychologically important level. It has broken its short-term bearish trend line, but that in itself is not really a clear bullish signal. It does, though, make the bearish case a little bit less compelling. However, it does need to go above 65 for me to turn a little bit bullish on the crude oil outlook. The overall trend, though, is still slightly bearish to neutral at best, given the fact that the OPEC is pumping more oil than is needed at the moment, and the demand forecast is remaining weak. So I'll take this breakout with a pinch of salt. Let's see what will happen in the next couple of days, but as a minimum, I would like to see crude oil price above the $65 level before turning slightly bullish on it. So keep an eye on oil prices, because if it were to go back below this broken trend line now, that would be a big bearish signal in my view. However, if it can hold the breakout, then at the very least we could potentially test the 200-day moving average at 66.80ish. Then above that we have resistance, or potential resistance, at 68.50. So in any case, I think the upside potential is limited, except if we have a major escalation in the geopolitical tensions concerning Russia, or something flaring up in the Middle East again. Now, with crude oil and copper prices rising sharply today, this has been a good day for the FTSE, which has also benefited from a weaker pound. Remember, the weaker pound is usually a good sign for the FTSE, given that a lot of the UK listed companies earn their profits from abroad. So when they convert that back into the pound, it makes it look bigger than it is really if the pound is weaker. So for those reasons, we've seen the FTSE bounce back today, printing a bullish engulfing like candle on the daily time frame, which is very interesting. And support at 91.90 held once again. This level has been tested on multiple occasions this week, and so far it's holding firm, which is positive news for the bulls. From here, it looks like the FTSE can now kick on and push towards a new all-time high. The last all-time high was at 93.60, hit at the end of August. That level now is the next potential upside target for the bulls. For more market updates and insights, make sure to check out the news and analysis section at cityindex.com. I'll see you in the next video. Take care.